Okay, good afternoon and welcome back everyone to our Options Education webinar series. My name is Tony Zhang. I'm the Chief Strategist here at Options Play. And today we're here to talk about how to utilize options for enhancing your equity positions. Now, this is a webinar really for those of you that are stock and ETF investors, whether you're looking to buy and sell individual stocks or you're looking to enhance your positions that you currently own. We want to talk about how to utilize options to go about doing that. Now, before I get started, just doing a quick sound check. If you can hear me, please bring up your chat window and type yes into the chat window, just so I know that everyone here can hear me. Okay, perfect. So let's go ahead and get started here. What we want to do is, before I get started, just a quick disclaimer. What we're going to discuss here today is purely for demonstration purposes. It is not a solicitation or a recommendation to buy or sell any specific securities. And for those of you that are brand new to Options Play, welcome. We're here to really help you, not only provide you with the tools that you need to learn how to trade options, but also provide you with the platform and weekly ideas for both income strategies as well as for speculation strategies. So you can all sign up using this link here on your screen, which I will post into the chat window for everyone who wants to get started. So you will get a free 30-day trial to the platform that I'll be showing you here today. You'll have access to the cover call and short put reports I'll be showing you later after the presentation, as well as access to a free 12-step options trading course for those of you that are learning how to trade options to jumpstart your trading, and daily options trading ideas are sent out to you as part of the service. So you have a free 30-day trial, and after those 30 days, you get a membership for just $75 a month or $500 a year. So let's go ahead and get started here. I have a lot to cover, but what I really want to talk about is how to utilize options for your stock investing. So how many of you currently invest in stocks? Please type stocks into the chat window if you invest in either stocks or ETFs. I would imagine that most of you here on this webinar probably in some way, shape, or form invest in stocks or ETFs. Okay, great. I see a lot of you, right? And we usually don't think of stock trading and options trading in the same picture, because we usually think of options as fairly speculative in nature. They have asymmetrical risks. So what you're really looking for is two different asset classes that most people don't consider complementary. But what I want to show you here today is actually how you can actually really enhance your stock and equity investments by utilizing option strategies that aren't really option strategies. They're really strategies to help you buy your stocks and then eventually sell your stocks at a higher price, hopefully at a profit. And those two strategies are really going to be covered calls and cash secured puts. So we're going to talk about why these are the top two income strategies for your portfolio. And we're going to talk about why your equity investments provide an opportunity for you to generate income much more so than any other option strategy could potentially generate income. It's really your options, your equity investments that provide this type of opportunity. Once we understand the two strategies, then we'll take a look at what are the optimal income strategies. We'll talk about how do you select the best expiration date, how do you select the best strike price for trading. And then what I want to do is I want to show you how you can use these weekly reports that we're sending out to you every single Monday. And what we're actually going to do is we're going to start increasing the frequency of that multiple times a week. You can bookmark those. We're going to update those every single day. So regardless what day of the week that you want to sell cover calls, you're going to be able to utilize Options Play's reports to help you find the best opportunities. And then what we'll do is we'll show you how to automate everything using Options Play, the tool that you all have access to help you automate everything we're going to teach you here today. So I'm going to start off by talking about short puts. Now, for those of you that have ever sat through any type of income-related options education, you'll see that almost everyone starts with cover calls first, because cover calls is the strategy that everyone can trade when you first apply for an options account. But cover calls assumes that you already own the stock, but you have to first buy that stock first. And that's why I want to talk about short puts, because selling a put is the strategy that allows you to own the stock that you want to purchase. So selling a put is similar to placing a limit order. So think about a stock that you want to buy. Think about Apple trading at roughly $240 right now. You think you want to buy the stock maybe at a slightly lower price. what do you do as an equity investor? You place a limit order. What does that limit order do? That limit order obligates you to buy the stock at the price that you place your limit order at. Selling a put option actually obligates you to the exact same thing. So selling a put is a strategy that allows you to not only buy the stocks that you want to purchase, but do so at a discount. How big of a discount do you ask? Most of the time, you'll find that you're going to get roughly 50 to 100 basis point discount on the stock purchase. Now, that's in what we would consider normal times. Right now, things are not normal. Volatility is much higher. You're actually going to get a significantly larger discount in the current market environment versus normal. So if you're looking to pick up some stocks, you think things are stabilizing, you're thinking about what stocks should I purchase, this is a great way to purchase those stocks at a discount using this type of strategy. So selling a put, like I said, is very similar to placing a limit order, because when you sell a put at the purchase price that you want to acquire the shares at, what you're doing is you're obligating yourself to buy the stock at the strike price that you sold at expiration. The only difference between a limit order and a short put is that each short put will deliver 100 shares. So you have to trade in 100 share increments, unlike a limit order where you can trade in any share increments. And when you sell a put, just like a limit order, you have to post cash or margin in order to sell those puts. So very similar outlook as placing a limit order. You would literally place a short put at the same strike price as you would place a limit order. And this gives you two possible outcomes once you sell that put. This stock, let's say you have a $100 stock and you want to place a limit order to buy the stock at 98. So you can sell a $98 put. So at expiration, two things can happen. The stock can either be below 98 or above 98. Those are your two possible outcomes. So we want to know what will happen if you sell a put and the stock is above the strike price, or what happens if it's below the strike price. So first of all, if it's above the strike price, pretty straightforward. What happens is your put option expires worthless, and you can do this over and over again. You can continue to sell more puts if you still want to purchase this stock at that $98 or whatever new price that you want to sell it at. And we call this rinse and repeat, because you can continuously sell puts and collect income as you wait to purchase the stocks that you want to own. Unlike a limit order, if you place a limit order at 98 and the stock doesn't decline to 98, you have nothing to show for your limit order. For a put option, you get paid. If the order doesn't execute, you can sell another put. If the stock does move below your strike price, now you own the stock at the price that you wanted, which was $98 plus a discount factor. So you actually own it at the strike price minus the income that you receive. So if you collect $2 on this particular put, you actually now own the stock at $96. So you got a $2 discount on your stock purchase. So this is the first step in utilizing options to enhance your equity positions. And most people don't consider selling a put option as an alternative to placing a limit order to buy the stock. So this is, in my opinion, the most underutilized option strategy for any equity investor. Because why wouldn't you want to purchase your stocks at a discount when you can by selling a put option as opposed to placing a limit order, especially if you traditionally use a limit order to buy your stocks? So before I move on, I just want to do a quick survey here. Does this make sense to everyone? Please type 1 into the chat window if this strategy makes sense as to why you want to sell a put option or consider selling a put option if you want to buy some stocks. Okay, great. I see a lot of ones. Perfect. So if you use, regardless of whether you use a limit order or a short put to acquire the stocks that you own, or maybe you already own the stock, maybe you've held onto the stock for years, right? But the stocks that you own in your portfolio, why do you own those stocks? You own those stocks because you think they're going to rally. You think they're going to go higher. So the only way that you can profit from that is if you're able to actually sell those stocks at a higher price. So that's really where we turn to cover calls. Now, many places will talk about cover calls as an income generating strategy, and it's absolutely true that you generate income from selling a cover call. However, I think that it's more important that you think about cover calls as a way to take profit on your stocks when they rally significantly, because that's really when you want to be able to realize the gains of the risk that you're taking. And the income that you receive, actually, in my opinion, is secondary. It is a great addition to being able to take profit on your stocks, but it is secondary. Your first and primary interest is taking profits on the stocks that you own so that you can take that money and perhaps roll it into another stock that you think is going to rally significantly. So selling a cover call really is a strategy that you should consider at the target price of the existing stock position. So in the example before, let's say I own a stock that's trading at 100, and I think the stock is going to rally higher to maybe 110, then you can choose to sell your cover call at 110 and wait for the stocks to rally. Now, what do you traditionally do as an equity investor? You place a limit order at 110 and you wait for the stock to rally to that price, right? And that thing could take a day, a month, a year. It can go down first, then rally back up. You might wait a while for that order to execute. So while you're waiting for that order to execute, a limit order doesn't pay you anything. But when you sell a cover call, you get paid income. And that's the difference between placing a limit order to hopefully help sell your stock at a later price for a profit, or selling a cover call. The difference, though, is that when you're selling a cover call, you have to own at least 100 shares, because each call you sell obligates you to sell your stock at the strike price upon expiration, but it obligates you to sell 100 shares of it. So you must have at least 100 shares in order to do this. So that's why it's important that, especially in this environment, that if you are investing in stocks or ETFs, many times you might find that you don't have enough money to own 100 shares of a higher price stock like Lockheed Martin, or perhaps even Apple. But for the smaller cap names, for the smaller price names, or some of the smaller price ETFs, so you might want to shift your money into some of those other vehicles in order to sell cover calls on. So this is not necessarily a strategy for all the stocks in your portfolio, but it certainly could be a strategy on the stocks that you have at least 100 shares of. And just like the short put, when you sell a cover call, you have two possible outcomes. The stock at expiration can either be above your strike price of 110, or it could be below your strike price at 110. Now, if the strike price, if it's below 110, just like a limit order, nothing happens. Your call will expire worthless and you keep your income. And you can rinse and repeat this strategy until the stock rallies up to that price that you want to sell it at, and you will take profit on the stock and you will keep the income that you received. If the stock goes above your strike price, just like a limit order, now what happens is you've now sold your stock. In this particular case, you would realize a $10 profit on the underlying stock, plus the income that you received on the underlying for selling the cover call. That would be your total income. So if you sold that call for $1, then your total profit on the particular trade would be $11, $10 from the stock, $1 from the cover call. So those are the two strategies that we're going to explore a little further here today, and talk about some real strategies, real examples to make this a little bit more concrete for everyone here today. Now, before I move on, I just want to make sure everyone understands, does cover calls make sense to everyone? Please type 2 into the chat window if that makes sense. Okay, perfect. I see a lot of 2s. And for those of you that feel that you're not quite catching on, don't worry. Options trading is something that does take a bit of time to learn, right? I don't expect everyone, especially if you're brand new to options trading, to just watch this 15-minute introduction to cover calls and short puts and immediately understand. It takes time to learn. I also encourage you to take a look at the previous month's, the February course that we provided, which gets into some of the mechanics of call and put options and the mechanics of buying and selling options. Really important to review some of that material first before jumping into cover calls and cash secured puts. But this is the next progression. If you watch those videos in February, this is how you can start applying those videos to your portfolio, by starting with cover calls and cash secured puts. Specifically for those of you that are equity investors, this really has nothing to do with speculating on options. This is really utilizing options for your equity investments. So I have 2 examples here, and I'll just go through them really quickly, because I'd rather spend the time going through real examples rather than fictitious examples. But I have stock XYZ trading at $100 a share, and what I want to do is I want to buy the stock at 95, and I think the stock is going to rally further to 110. So the stock's at 100. I think it's going to decline a little bit to 95 and then eventually rocket higher. That's my goal. So as an equity investor, I would buy my stock at $95 by placing an order, placing a limit order. As an options investor, I would sell a $95 put option, the same price I placed my limit order, but collect $2 here. And the goal here is two things. Number one, I want to reduce my risk. And this is one of the things that a lot of investors may not understand at first, but the second you sell that put option, you've immediately reduced your risk, because by selling that put option, the second you sell it, not when you close it, when you open the trade, you've immediately reduced your risk from $95 a share down to $93 a share, because you receive that $2 income immediately. So even if the stock goes to zero, you're immediately $2 better off. Might not be that big of a deal from if you lose $93, you know, the difference between 93 and 95 may not sound like a lot, but you are immediately reducing your risk by $2 a share. And going for the stock going to zero is probably an unrealistic example. But I think what's a more realistic example is that if the stock plummets to $90 instead, right? Many times you might say, I place a limit order at 95, the stock drops to 90. And you say to yourself, well, damn, I just lost $5 a share as an equity investor. As the options investor, you only lost $3 a share. So you've reduced your risk by almost half in that particular example. So that's why it's so important to consider utilizing short puts to enter your stock positions, because the second you sell that put, you're immediately reducing your risk. And what that does is it increases your potential reward from $15 a share to $17 a share, because you collect that $2 income once you sell that put. And the goal here is to really provide you with some type of exposure by generating yield, because you have to put aside $9,500 to place that limit order, or $9,500 to place that short put. You actually only have to put up $9,300 to place that short put, because again, you're collecting that $2 income. So, and the reason that you want to do this is because limit orders don't always get filled, right? Sometimes you place this limit order and the stock just shoots off, right? And your limit order goes unfilled. In that particular case, if you sold the put, at least you have $2 to show for that. So even if the stock never declines to $95, you collected $2. Not a bad result at the end of the day if that was to happen. Certainly much better than having nothing to show with a limit order. Now, once you own that stock, let's say you do end up owning the stock at 95. As you wait for the stock to rally up to 110, you can either place a limit order to sell that stock at 110, or you can sell a cover call for, let's say in this particular case, let's say you collect $1 for that cover call. But in the stock example, your risk reward stays the same. You're risking $95 a share to try to potentially make $15 a share. But when you sell a cover call, you continuously reduce your risk. Before, we reduced our risk from 95 to $95 to 93, because we collected $2 on the put. And then when we sell a cover call, we're removing another $1 worth of risk. And as you will learn going forward, is that sometimes you might sell multiple calls before the stock rallies up to 110. So you might collect another $1 and another $1 and another $1. Before you know it, you've reduced your risk by a total of $6. So now your total risk is down to 89. So the goal here is to continuously reduce your risk on your equity investments. And this is what I mean by enhancing your equity investments, because these strategies allow you to further reduce the risk on all the trades that you make from your stock investments and increase your potential reward. Each cover call you sell will also increase your potential reward on that particular trade. And in both of these, you have the only exposure that you have in XYZ is until the stock rises to 110. Here, as long as the stock stays below 110, you can collect an income stream. And that income stream, in the examples that I'll show you in the next few slides, is significant. So let's just quickly review, how do you actually go about selecting the right expiration date and strike price for this strategy? Because I think most of you here, at least conceptually, probably understand what I'm explaining. But when it comes to actually implementing it, meaning pulling up a stock in your portfolio that you want to purchase, or pulling up a stock that you already own, and you're staring at that options chain and you're trying to decide, okay, I understand selling a put, I understand selling a cover call, but how do I select the right expiration date? How do I select the strike price? And I want to make sure everyone understands the research on how to select that. So we're going to first talk about expiration dates, because expiration dates for cover calls and short puts follow the same methodology. So you can select from, when you look at an option chain, you have plenty of expirations of going out from April, May, June, July, all the way out through a couple of years out, right? So the further out you go, the more income that you're going to see on your cover call or short put. So naturally, what many equity investors or many traders do is when they're trying to sell options for income, whether it's a short put or a cover call, they tend to go for the longer dated options. Doesn't necessarily mean that you go out 3 months, but if you're looking at May or June, people tend to go towards the Junes because the Junes have higher income. Who doesn't want higher income, right? That's what we're talking about, is we want to get a discount, we want to get an income stream. But this is really where the part of options trading that's very counterintuitive. And it's important to think counterintuitively when you're trading options, or in many aspects of trading or investing, I think is very counterintuitive, but specifically with respect to selecting expiration dates, because we tested this. We tested short dated options, we tested long dated options, and our research clearly shows that when you're selling options, you want to sell short dated options, the options that actually have the least amount of premium, where you're going to get the least amount of income. And that, again, very counterintuitive. But the reason for this is twofold. Number one, when you sell options, you want to avoid selling during earnings. I think this part, probably most people can understand why you don't want to sell a cover call or a short put going into earnings. But how do you actually avoid earnings? You can avoid earnings by selling short dated options. If you sell 1 month options, you can do those 12 times a year. And if you do those 12 times a year, 4 of them will have an earnings cycle built into it. So you can still sell the other 8 months out of the year. Versus if you sold a 3-month call, you're going to get more income for it, but you can only do that 4 times a year. So every single call you sell has this earnings cycle built into it, so you can't avoid selling earnings. So first of all, just due to that, you want to sell shorter dated options so you have the flexibility of avoiding when earnings are going to come up. But the real reason as to why you want to sell shorter dated options is because the premium that you receive is not linear to time. What I mean by that is if you sell a 1-month call, let's say you look at the 1-month options chain and you see that the option is currently trading at $1. So you say to yourself, well, what if I went 3 months out? Can I get $3 for it? The answer is no. The answer is you're only going to get roughly $2 for it. So what that means is that in a 3-month time frame, I can sell 3 1-month calls and collect roughly $3, versus if I sold 1 2-month call, I can only collect $2. But even if I avoid the month where there's earnings, I can still collect the same amount of premium without taking on the risk of earnings. And that's why when you're selecting expiration dates, shoot for the shorter dated options. You don't necessarily have to trade weekly options, even though weekly options many times are quite suitable for this type of strategy. And I'll show you in a few minutes why. But if you're looking at 2 different expirations, you're looking at the Mays, you're looking at the Junes, you should always skew towards the shorter end of the curve whenever you're choosing options. And I want to make sure that's clear to everyone. Please type 3 into the chat window why it makes sense to sell shorter dated options when you are utilizing these types of strategies. Okay, perfect. I see a bunch of 3s. So now let's talk about strike prices. This is where it does differ between cash secured puts or short puts versus cover calls. So let's use the example before, right? I have a $100 stock that I want to buy. So there's lots of places that you can place a limit order, right? You can place a limit order maybe at 98, very close to the current price. You might place a limit order maybe at 95, a little further away from the current price, or you can place one maybe really far away at 90, right? So each one of these that you sell will have a different probability of the stock reaching, right? So think about placing a limit order at 98. You have a pretty good chance that order will get filled. The stock doesn't have to move very far in order for a limit order or short put of that magnitude to get filled. At 95, it's going to take a little bit of a bigger move for the stock to move before this order gets filled. And at 90, it would take a really big dip for the stock in order for it to move. So I have three different opportunities here. You can sell conservative, optimal, or aggressive short puts. The conservative ones refer to these $90 puts because the stock needs a much bigger dip in order for the stock, in order for the strategy to execute. These conservative ones will provide a lot less income for you on your trades. Now, much higher strikes require a much smaller dip in the underlying stock, and these will give you much higher income. So the question is, which one should you pick when you're selling put options? And the answer from our research is pretty straightforward, meaning you should sell aggressive strike prices near the current price of the stock. So these $98 put options are the way to go. And the reason for this is, number one, you're selling a put option because you want to own the stock. So you generally want to increase your probability of owning that stock. And the way to do that is by selling a strike price near the stock price. So if the stock's at 100, you want to sell a put strike that's close to the current price. But the second reason is because these the put options that are close to the current price provide higher income, which gives you a larger discount on your stock purchase. So it's really a win-win here because you have a higher probability of owning the stock that you want to gain exposure in, and you get a higher discount factor on that underlying, on that short put. So does that make sense to everyone? Please type 4 into the chat window why you want to sell a put option close to the current price of the stock. Perfect. Now let's jump lastly to cover calls. Now, same example, $100 stock. I believe that this stock is going to rally, so I can sell I can place a limit order or sell a cover call at a lot of different places, right? Maybe let's say 105, let's say 110, and then let's say 115. So the 115s are these conservative strike prices. These are much higher strike prices. The stock needs to move significantly further for the stock to rally up to 115. This gives my stock a lot more upside. These are higher strikes. These are going to provide less income. The lower strikes are much more aggressive. These will give my stock a lot less upside, so my stock will get called away much sooner. They will provide more income. So the question is, which one do you want to choose? Now, this also, I think, is one of the more counterintuitive aspects of trading options, because when you're looking at an option chain, you're thinking to yourself, cover calls is an option trade, is an income generating strategy. So why not choose the strike price that gives you the higher income? And that's what we see a lot of investors do, is they pick these 105, 107 strikes because it generates a high amount of yield. And you're thinking to yourself, well, I want the highest amount of yield. But our research shows it's the exact opposite. You want to focus more on the conservative end of the spectrum. And the reason for this is because the income that you receive is completely secondary to the true risk that you're taking when you're selling a cover call. What's the risk that you're taking when you're selling a cover call? Your risk is the stock that you own. You paid $100 a share for this stock. This stock could go to zero in theory. You're taking on that risk. So how do you compensate for that risk? You have to compensate for giving yourself enough room to be even worth taking on this type of risk. So you're going to get a smaller amount of income, but again, income is secondary to the primary reason of why you own the stock. You own the stock because you think it's going to increase in value in the future. So make sure that you compensate yourself for that potential return. So selling cover calls, you want to make sure that you actually sell cover calls that are very far away. I see a question here from Ralph asking, what is POW? POW is actually the probability of expiring worthless, because this 105 call has a very high probability of expiring worthless. So you actually want a cover call that has a low probability of having your stock called away, because you want the stock to make an outsized move to the upside in order for your stock to be called away. And yes, you're going to collect less income, but many times what you're going to see is that if you sell that 105 call, maybe you collect, let's say $1.50. And then what you're going to see is that the 115 calls maybe collects 30 cents. And you're thinking to yourself, well, I certainly want $1.50 than 30 cents, but think about it here. You're basically giving up $10 in upside in the underlying stock in exchange for what, $1.20? So you're giving up a $10 in upside for $1.20. That is an equation that never adds up in the long run. So that's why whenever you're choosing cover call strikes, choose strikes that are close, further away from the current price, because you want to prioritize the gains in the underlying stock, because that's the true risk that you're actually taking, is that $100 a share, not the 15 cents or 30 cents. You know, that's pennies compared to the $15 that you're trying to gain on the underlying stock. And I hope that makes sense. So please type 5 into the chat window if that makes sense to you. Okay, perfect. I see a lot of 5s. So we're just going to do a quick recap, and then let's jump to some real examples here. So first of all, try to acquire your shares at a discount by selling a cash secured put. When you sell a cover call, or when you own a stock, or when you buy a stock, whether it's through a limit order or a cash secured put, you generally want to sell cover calls immediately. And the reason for this is because I've been getting a lot of questions lately from people who perhaps have bought stocks a few months ago, or even as the market sold off. You have a $100 stock and you don't sell cover calls immediately, and at some point later, maybe the stock drops to 50, and now you're asking, is it time to sell cover calls? Because you're thinking about, how do I get myself back to break even? You're thinking, oh, if I collect $1 a month, I can get myself back to break even sooner than later. It's really too late to start selling cover calls when you're down 50%. You have to start selling cover calls immediately after you start acquiring the shares. You need to start building that buffer immediately. When you're down 50% or even 20% on a stock, sometimes at that point, it is a little late. 20%, you can still start selling cover calls, but beyond 20%, it's really difficult to sell cover calls, because even if the stock rallies significantly, you're still well below your cost basis, and many people don't want to sell their stocks at a loss. So keep that in mind when you're thinking about which stocks do you want to sell cover calls, when do you want to start selling cover calls. The answer is you want to start covering calls constantly, immediately after you start owning those shares. When it comes to expiration dates, make sure that you understand that shorter dated options maximize time decay. Again, very counterintuitive part of options trading. When you're selling puts, you want to sell puts near the stock price. When you're selling cover calls, you want to sell cover calls further away from the stock price. And generally, you want to avoid selling options going into earnings. So that's just a quick recap of everything we discussed here today. And what I want to do is I want to show you some real examples, and I want to show you the reports that we have built to help you better understand how to utilize this type of strategy. So we're going to turn over to Options Play. Now, this is the tool that either you have a free trial to or you're currently a member. And this tool is really designed from the ground up to try to make your options trading as simple as possible, so that you don't have to pour through pages and pages of option chains to figure out where do you want to start. We built this tool to make your income options trading experience as simple as possible. So the tool itself is divided into 3 sections. You have trade ideas, watch list, and portfolio on the left. You have your security analysis panel here in the middle, and then you have trading and income here on the right-hand side. So we're going to go to the income tab, because that's really where we want to focus our attention on here today. And we're going to use some stocks to start off with. Let's look at Apple, for example. And I'm using Apple, let's use Apple, for example. I'm going to use Apple as an example because this is a stock that we've highlighted on our market outlook the other day. I think this is a stock that, if you're looking for investments, is a strong stock to consider. This is, again, not a solicitation for you to go out and buy Apple, but I think that out of all the stocks to look at, this is one of the stronger cases. So when you click on the income tab, it'll ask you, do you own shares of Apple? Now, if you're thinking about buying the stock, the answer is obviously no. So when you click on no, it will select a short put for you. Now, you can set your own settings as far as how you like to sell puts. So you can sell, for example, for calls, you can sell short-term optimal. For puts, I like to do short-term aggressive. And you can select whatever settings that you'd like, but obviously we're teaching you based on our outlook that, generally speaking, when you're selling calls, you want to be conservative or optimal. When you're selling puts, you want to lean more to the aggressive side. So when you save this as default, Options Play will go out and seek the expiration date and strike price for you, so that you don't have to do the searching manually. So if we're looking at Apple's trading at 244 right now, this is telling me to go out to April 24th, which is only 22 days away, so a relatively short dated option. And it's telling me to sell the 230 puts, which is only $15 below the current price of the stock. And in this current market environment where Apple can move 10, 15 bucks in a day, going out 2 weeks, 15 bucks below is quite aggressive in my opinion. And what I want to point out here, really interesting, is that even though Apple doesn't report earnings in 26 days, and this option expires in 22 days, so before expiration, I'm going to collect $655. And I want to walk you through this, right? So to buy 100 shares of Apple, normally at 230, you would have to place a limit order at 230 and have $23,000 in your portfolio in order to place that limit order. Now, to sell this put, you don't need $23,000. You only need $22,345, which reflects the $655 discount. Now, how much is $655? It is a 2.67% discount. So in 3 weeks, you can own Apple stock at a 2.6% discount to the $230 level. That is a significant discount for a stock like Apple. Normally, in normal market conditions, you would be lucky to get around 1% discount on a stock purchase like this. Here, you're getting 2 3/4 because the volatility is higher. Put premiums are fairly elevated. Out of the money puts are even higher. So you're getting a very nice discount here, $655 per 100 shares. If you're trading multiple contracts, you're going to get a significant savings in terms of your discount, in terms of your stock purchase. And we built this in a way so that you can create a watch list of any stocks that you want to own. And I just have a quick list here of some stocks that some of you may be looking to add to your portfolio. We were looking at T-Mobile. This was the trade of the day from a couple of days ago. This is also a very interesting telecom stock. I think this is going to be a clear outperformer here in this particular market. Selling a put option here. So this is trading at $84. Now, this put option actually looks like it's not providing you much, but these are after-hour bid-ask prices. So as you can see, things are very skewed. Bid-ask prices on T-Mobile after hours are really high. But maybe let's take a look at a stock like Disney. Maybe some of you are thinking, this is a really nice stock to buy because just a few months ago, it was trading in that 150 level and you thought this was a pretty good price to get in. Well, certainly $94 is a much better price to get into Disney stock. So let's take a look at buying Disney. So buying Disney, same thing, going out to April 24th. This is telling me to sell the $90 put options. $90 put options, which, as you can see, is roughly $7 below the current price. Disney in this current market environment can move $7 in just a day or two. And this is giving you $375 discount on a $90 stock. So to put 100 shares of a limit order for Disney at $90 a share, you're looking at $9,000 that you need to place a limit order. To sell the put, you only need $8,625, which is a $375 discount, which in this particular case is 3.8% of the underlying stock price, even higher discount factor. And this Disney does not report earnings until 34 days away. Normally, we never see these types of discount numbers unless there's an earnings coming up. And even with earnings for some of these large cap stocks, you're not going to see these types of discount factors. So if these are the types of names that you like and you like them at these types of levels like $90, which I actually happen to like Disney on this particular trade, this is a great way to lower the cost of owning the stock from $90 a share to $86.25. That is a significant discount. $86.25 puts you near that 52-week low we just put in. I certainly would rather own it at those lows rather than the current price of $94 a share, $96 a share. And this tool is really designed from the ground up to allow you to click on any symbol and within a couple of seconds know exactly which stock, which expiration date, what strike price to sell, and it gives you the yields so that you know exactly how big of a discount. Now, JPM does have earnings in 12 days, so I may not be interested in selling this particular put, but as you can see here, this is 3.8% discount. Usually these types of discount numbers only come into play when there's earnings coming up, but as you can see in the previous examples of Apple and Disney, we're seeing plenty of examples of getting 2-3% discounts on the purchase of your stock. And for those of you that have been receiving our weekly short put report, we've been putting this out for over a year now. Every single Monday, you get this report at 10:30 a.m. And what this does is it gives you a list of all S&P 500 stocks, and you can go through them. At the top of the list these days are stocks that you probably may not want to venture into just yet, like Royal Caribbean, United Airlines, where you are getting 19-20% discounts. And maybe for some of you, you're a bit more speculative and you do want to jump into something like that. On a stock that's trading at $25, you can sell a $25 put option and collect a 20% discount on the stock purchase. That is a significant discount. Annualize that out, that's 340% return on your cash. So even if the stock rallies and doesn't execute your trade, you're looking at a 340% return on your cash in the next 44 days. So this is very speculative, obviously. If you go a little further down the list, you might find some names that are a bit more stable, that you're more interested in. Maybe something like GE that's trading at a little over $7. You can sell a $7 put option and collect an 11.5% discount on that stock purchase because you're collecting 82 cents on a $7 stock. That's 11%. So these are significant gains in very, very large cap stocks. Normally 11% are really yields that you only see in very, very small cap stocks, very volatile stocks that are not very liquid. Here we're talking about big name stocks like GE, Citigroup, same thing. A little over a 10% discount. So again, not all of these stocks do you necessarily want to own, but for some of these stocks that you do want to own, Micron, about a 10% discount on Micron stock. So, you can look through this list and look for names that you think that you want to purchase, and you can utilize this to help you inform your decisions and quickly understand how big of a discount are you receiving, what strike price, and what is the price you're going to receive on that short put. So now let's take a look at stocks that you own, right? Now let's look at cover calls. So let's say you have some stocks in your portfolio. Many of us do. Some stocks that you might have picked up over the last few days, some of the stocks that you might have owned for years. Let's say you have Microsoft stock. And you're thinking to yourself, well, if this stock rallies significantly, I'd like to take profit. So what can you do? When you click on the income tab, again, you can select yes if you own shares of Microsoft. And now what we do is we just flip the dime and we look at short put cover calls instead of short puts. So here, this is telling me to go out to April 24th. Again, a short dated option because short dated options allow me to extract more yield in the long run. And selling the 170 cover calls, which is $15 above the current price of the stock. So the stock needs to rally back up to this level around 170 in the next 3 weeks in order for me to take profit, which is a pretty good move on the underlying stock, roughly a 10% move in just 3 weeks, which is a significant move. And I'm collecting $151 in income. How much is $151? It is roughly 1% of the underlying stock price in 22 days. So you're going to get a 1% additional reduction in the cost basis of your stock in the next 3 weeks by selling a cover call. And this yields a 16% yield on a stock that pays a 1.2% dividend yield. So normally we don't see these types of yields for a stock like Microsoft. I think normally you probably see 7, 8, 9%. But again, because implied volatilities are elevated, you're seeing significantly higher yields. So even on a big name stock like Microsoft, that's traditionally not a very big mover, it's a beta of 0.44, very low moving stock, yielding you 16%. Because and on a 12-month projected yield between the dividend and the cover calls, you're looking at 17% yield. And this is the type of of yields that you can expect today. So especially for stocks that you think are going to be a bit more range bound for the next few weeks or next few months. And there might be a lot of stocks that fall into this category, maybe a stock like Facebook, where you don't think advertisement is going to recover anytime in the next few months. And based on the outlook that we're currently seeing, that certainly seems to be the case. Looking at a stock that's trading at 158 right now, selling the 177.5 call options, collecting $106 in income. This is a little lower, 0.67% of the underlying stock price, but that's still 11% annualized yield on a stock that pays 0 dividends. So if you own Facebook stock, and there's a lot of tech stocks in your portfolio that may fall into this category where you're not getting any yield, cover calls fall into that. This really falls into that particular category where you can generate some yield as these stocks trade sideways and perhaps still continue to move a little lower. And for those of you that are able to join us in our market outlook sessions on Tuesdays and Friday mornings, we'll talk a little bit more about our expectations of the market going forward. But if you feel the market's going to be sideways like we do right now, these are the types of strategies that you can implement for your stock portfolios and generate a fair amount of yield. If we look at GE, if you own GE stock, this certainly has not been a great stock to own, but you can sell that May 88.5 call option, which generates $15 in yield, and that's the bid-ask price. So let's take a look at the mid price, which I think might give you a slightly better return here. If we look at GE, the mid price here is 20 cents. So 20 cents is still 2.9% of GE stock. So you can get an additional 2.9% reduction in your cost basis in the next 29 days, which annualizes to 36% on a stock that pays you less than about 0.5% dividend yield. So even in these low price stocks, and we're talking about a really low beta stock, we're talking about a stock that is not sexy at all, doesn't move a whole lot, you're going to be able to generate a huge amount of yield. And you can put this for any stock that you own that you think perhaps in the next few months are going to be a bit sideways. Maybe some of the more boring stocks like Coca-Cola. Coca-Cola, not too exciting. This is actually surprisingly low. $18 in income for a $43 stock, which is 6.79%. Maybe this is the bid ask. Okay, so here we go. This also has very wide bid ask spreads. This is one of the things that we have noticed over the last few weeks is that spreads are so wide for these things. So be very careful when you venture into these. We do publish a new liquidity list. We hope some of you have been looking at that liquidity list that you can find at trade.optionsplay.com/liquidity. Which I will post in the chat window. And as you can see, the number of stocks that are now in our liquidity scans are about 96. So a little contraction from the other day. The other day we had about 130 names. Here we only have about 90 something names here today. So liquidity has tapered off a little as markets sold off over the last couple of days. So we're still in a very precarious stage with respect to liquidity. And it's really important for us to focus on the more liquid names when we're trading here. So that covers what I wanted to go over with you here today. And lastly, actually, I just want to cover the cover call report real quick. The cover call report you should use by simply looking at the stocks that you own in your portfolio. So you can look through this list, and at right now, it's really some of the kind of junk names, if you will, that have sold off significantly that are at the top of the list. You might have to scroll a little further down on some of the stocks that you may own in your portfolio, or some of the big names that many people own. The airlines are certainly up at the top. But what's a name that I think probably a lot of people have in their portfolio? Let's see. Citigroup, maybe a lot of you have Citigroup here trading at $38. You can sell the 47.5 call options, collect around $1.05, and that yields 2.73% or an annualized basis of 25%. Lowe's, 25%. And you can use this tool to simply look at the stocks that you own in your portfolio and see how much yield you can get. UPS, 22% yield. I'm just looking for some big names that I know a lot of people have in their portfolio. A lot of small cap names here at the top of the list. Micron, 19% yield. These are significant yields that normally, it's in the 12, 15%. Now you're looking at 20, 25%. So you're seeing a lot of higher yields in this particular market environment. And it's a great time to utilize these strategies, especially, when markets are kind of in the sideways market. And we expect perhaps markets to continue to trade in this sideways motion over the next few days. Next few weeks rather, and cover calls is a great way to generate some yield or income for your portfolio in that meantime. So with that, that covers what I wanted to go over with you here today. Just a little bit of housekeeping before we open this up for Q&A. Again, just to remind everyone, we are doing weekly market reviews. The next one is Friday morning, tomorrow morning at 9 a.m., where we're going to go over where we currently stand, showing you some of the macro research we're looking at. Earnings season is kicking off soon, so we want to start taking a look at that, even though we don't really have a good template for how earnings season is going to play out this particular quarter. But I think earnings season is really important to pay attention to give us a better understanding and to quantify just how bad things are and just how long these things might last. So you can sign up and register for that by going to trade.optionsplay.com/weekly. I'll post that link into the chat window. We're going to talk about strategy. We're going to talk about ideas. We're going to talk about what themes we see in the market. Really useful to help you set up your trading days. We do that every Tuesday and Friday morning. And lastly, I hope that you guys consider joining us as members. For those of you that are currently on a trial, membership is just $75 a month or $500 a year. You can sign up using the link that I sent to everyone here into the chat window. Again, this gives you access to daily options trading ideas, the weekly cover call and short put reports, access to the platform that I showed you, and the weekly options educational webinars like the one you are on here today. So with that, again, thank you so much for taking the time out here this afternoon. I'll try to answer some questions here before we log off. And I know many of you have some questions, and there's so many of them, and I unfortunately can't get to all of them, but I will try to address as many as I can here today. So again, thank you so much for taking the time out here this afternoon. Let's see, a lot of questions up here. Where are the February videos? So all of the videos on our YouTube channel, you can go to our Options Play YouTube to find those. We have a playlist both from the February one, which is under the Beginners Options Trading Course playlist. You can find those there. I highly recommend you to watch those if you're brand new to options trading. Do you have to hold on to the position until expiration? These two strategies you generally do. Most other strategies you don't. So most option selling strategies, you would try to hold them to expiration. Chaya is asking, in the event your stock is getting called away and unable to roll forward, would it make sense to sell a put to retake the position in that stock? Yes, absolutely. So if you sold a cover call and the stock gets called away, and you weren't able to roll that call, you can absolutely sell another put to try to get yourself back into that position. That is a perfectly valid strategy to do. But I will say that if a stock gets called away, that means the stock rallied a pretty significant amount. You might want to buy another stock. You might not want to buy that same stock unless you really want that stock. That's obviously a different story, but maybe you might want to consider a stock that's hasn't rallied, sell a put on a stock that you think has the potential to rally in the future. Brian's asking, does it make sense to write cover calls, and does it make sense to write cover calls and buying puts? And buying puts, yeah, absolutely. That is a collar strategy. That hedges you to the downside. You can use the proceeds of your cover call to pay for the put options. That is what we call a collar strategy, absolutely. Is it better to buy cover calls back on Thursday or wait until Friday before expiration? I think either one works. Thursday, there's not a huge difference between Thursday and Friday, but generally speaking, if you're trying to buy back your call and roll it to the next week, anytime in the last week before expiration, in my opinion, is a suitable time to roll your cover call. Why not sell options with 1 week expect dates instead of 21 to 45 days? Doesn't that give you more income opportunities? Yes, but there is diminishing returns as to how much premium you can get on a 1 week option. In theory, you could sell 1 day options, but it's gonna cost you more in terms of transaction costs, not just in terms of commissions, but in terms of bid-ask spreads. So you have to factor that in as well, because if you have large bid-ask spreads and you're paying 20% on the spread, then doing it every single week may end up costing you more in transaction costs. For selling cover calls, longer term or shorter is better. So I think I was pretty clear on our session here that, you know, selling shorter dated options are better. If you're down 50%, could you use cover calls as an exit, not really a stop loss? Yeah, absolutely. If you're okay with taking a loss on the underlying stock position, yes, you can sell cover calls on a stock that you're down 50% on. When can we start with storing portfolio stuff in options play? Laura, great question. I think we're trying to launch this in the next couple of months here. We're working on this right now. It's something that we're currently working on. And this will allow you to pull in your own portfolios and see your positions here as opposed to just our positions. Income strategies does not appear. Randall, if you don't mind sending me an email at info@optionsplay.com. We'll take a look into your account and see why you're missing that income tool. Let's see. Whoops, I think I might have lost that position here. What if the price of stock go further down than the put right level? Then you have the same problem if you put a limit order, right? If you could place a limit order and the stock drops, you take a loss, right? That's the risk that you're taking when you buy a stock. The only difference here is that when you sell a put, you're losing a little less because the premium that you receive on the put buffers that a little bit. So, but at the end of the day, you're still risking owning that stock. And this is only a strategy. Selling a put is only a strategy on a stock that you want to own. Disney is giving us a better ROI in the put than Apple. Well, I mean, but what do you want to own? Do you want to own Disney or do you want to own Apple, right? So one is not better than the other. So it really depends on which stock you want to own, not necessarily which put gives you the best ROI. Shouldn't you change the settings to conservative before finding the cover call? Absolutely, especially in this type of environment. So I would say it depends. You know, some people I like the optimal ones, but the conservative ones certainly provide the best upside. I'm less of a stock investor than some of you. For those of you that are stock investors, you might want to choose that conservative strike price. If you're pretty good at picking stocks that you think are going to rally, choose the more conservative strike. Is the target related to the resistance line? I don't know which target you're referring to. If you're talking about the target, you know, like on these, the answer is no. Those targets are based on standard deviation calculations. What time this Friday morning? They're always Friday mornings at 9 a.m. Eastern. So every Friday at 9 a.m. Eastern is when we do our market review. This is every Tuesday and every Friday. You can sign up using the link on your platform. Randall, your comment about support and resistance lines, I know we're working on it. I promise we're working on that right now. Could you show how to compute raw return? Raw return is simply just the income that you receive. In this particular case, 89 cents divided by the stock price of 280. And that's how you get the 0.35. So it's a really simple calculation. Does the program take into account minimum trading volume on the contracts? No, because volume we don't think is a good indicator of liquidity. I think you're thinking about using volume as a liquidity indicator. We use the bid-ask spread to calculate the options liquidity. That's a far better way to track liquidity, and that's how we are scanning for liquidity. Just so you know, for those of you that are interested, this liquidity report is actually sorted by liquidity. So I don't think it's a surprise to anyone that SPY, Apple, GLD are the top in terms of liquidity. And then at the very bottom, you have names like EMB, YCS. These are less liquid names. But right now, normally this list is about 500 names. Right now, we only see about 100. So this is telling me that liquidity is still nowhere near back to normal. Even things have stabilized a little bit over the last few days. Liquidity has not come back in the same way as the stability, if you will, of the market. Please show the annual return computation. So you can actually, the annualized return is really, you can actually find it by clicking on the tool. The formula for the annualized return is actually in the spreadsheet. What about Zoom? So Zoom is an interesting one. This stock declined quite a bit today. I think Zoom is a gauge for our coronavirus fears. The more fearful we are, the higher Zoom goes. The less fearful we are, the more Zoom pulls back. This is more of a trader stock. I don't think necessarily you want to invest in the stock per se. We traded this name earlier this year on options action, but right now I'm not touching the stock. The stock moves a little too much for me. Is there a link for the 3 lists you mentioned from the Options Play platform? So we are in the process of adding all of these links to our platform, including the Options Play liquidity list. So yes, we are working on all of that, but currently there isn't. We will announce it next week as soon as we get all of those things in. How do we get the list? This list is emailed to you every single Monday at 10:30 a.m. All you have to do is be either a free trial member or a subscriber to get access to that. Yes, a tool is asking, maybe we get a recording. Everyone gets a recording of this with the slides so that you can follow along. Peter, you're very welcome. Connor is saying, would you choose to sell a vertical put spread? Yeah, absolutely. So for those of you that maybe you don't want to take on the risk, or maybe you don't have the cash to sell a put option, you can sell a vertical put spread. But if you get assigned, you still need the cash or the margin to hold that stock, or else you're going to get a margin call. So you can to reduce the margin requirement, but if you get assigned, you're still going to need it. Praveen J. Bell, thank you so much. Joe, same thing. Can you please post a link to the cover call short put report? James, we emailed this out multiple times a week. So again, if you're on our mailing list, if you're not on it, please send us an email at info@optionsplay.com. But if you have a free trial or a subscription, you'll receive the link. Can you add Leap strategies to your platform? So Leaps are already on here. You can click on modify and you can use any strategy, any expiration date you'd like. All Leaps are already on there. Why not use verticals to ease the cash requirement? So Keith, you can certainly use verticals to ease the cash requirement, but number 2, you're getting a much smaller discount. So, here, if let's say I go back to Apple, sorry, AAPL. If I sold this put here in Apple, as you can see here, I'm collecting $655. I want a large discount, right? I want that $655 discount. And I'm only selling it because I have the cash to buy the stock, or else I wouldn't sell the put option. Yes, you can sell a put spread to reduce your cost, your margin requirement, but what you're also doing is you're significantly reducing the premium that you're receiving. So even if I sell something that's, let's say, $25 wide, oh, this is going out to May, sorry. We were looking at the April 24th. If I sell something that's 240? Oh no, 230. If I sell something that's in the 230 range, whoops. I'm collecting only 170. So I'm collecting less than a quarter of what I was collecting before by selling just the put option. So that's why, yes, you can use the put spread. It'll reduce your cash required, but you're collecting significantly smaller amount of income. And when you do get assigned, you're still going to need the $22,000 to acquire the shares. So that's generally why. Kaz, you're very welcome. Alan, what is your repair when the stock drops far below the sold put price? So it depends on how far it drops below the put price. Again, that's the risk that you take when you buy a stock, right? That the stock drops. There's nothing that can prevent you from doing that. The repair strategy is selling a call ratio spread. I actually have a video just on that alone if you want to learn more. It is a complicated strategy. It's a strategy that works in only very specific scenarios. So if you think the stock's going to recover, you can sell a call ratio spread to try to repair your strategy and get back to break even sooner than later. Better to sell weekly options than monthly? Oh, so the reason I was telling you to sell weekly options is because if you look at the weekly options, you have strike prices that are 2.5 strike prices apart. So you can get really fine in terms of where you want to place your limit order. If you look at the monthly options, they are $5 apart. So you have far fewer options. Well, here in Apple actually has the same number of options. But if you look at something like, let's look at XLV, right? We have a position in XLV. What you'll notice here is the weekly versus monthly options have far different strike prices. So here are the Mays. These have dollar strikes. The weekly options have 50-cent strikes, right? So and maybe this is not a great example. I'm trying to find a good example here for you. But what we notice is that, and maybe this is changing a little, but we've generally noticed is that the monthly options have, in this particular case, like Apple, the strikes are $5 apart. That's a pretty big difference versus the weekly options, as you can see, are $1 apart. Well, maybe they've changed things a little bit, but yeah. So as you can see here, in the 150s or below 150s, they're $1 apart. I think right now the exchanges are probably having trouble listing things fast enough as things move so fast. But yeah, so here for Microsoft, if you look at the weekly options, they trade in dollar increments. I think they're still trying to catch up on listing enough strikes here. But as you can see, earlier this week when it was trading in the 140s, they listed dollar strikes versus on the monthly options, they're still $5 strikes. So that's why, I tend to find that sometimes when you're trading weekly options, you get to fine tune them, and maybe they're adding more strikes right now. But that was the general reason why I say that. Is your 12-month projected yield based on 12 months of put on? Yes, that's correct. So it's based on selling for the full 12 months. That's correct, Jeff. What does a roll mean? A roll means that if you sold a cover call, let's say you sell this April 177.5 cover call, and let's say you're approaching options expiration, let's say it's April 23rd, and let's say the stock's at 180. And you don't want to sell the stock. You don't want your stock to be called away at 177.5. So what you do is you buy back your April 24th 177.5 call, and what you do is you sell another call, maybe a May 190 call or 195 call. And the process of buying back this call that you currently have and selling the subsequent May call, if you do that in a single order, and you can do that at most brokerage firms, we call that a roll trade. You're basically rolling your contracts from April out to May. It's just a technical term, but what you're really just closing one option and opening up a new one. Mark is saying, I sell puts like Microsoft, April 141, receive 385 or 385 per 100 with the idea that if it goes higher, I keep the money. If it goes lower, I don't mind owning it. Is this the strategy? Absolutely. That's exactly the strategy, Mark. You've got it nailed it on the head. Let's see. If your cover call exceeds the call price, is it smart to buy back your call? Yes. Please do a session on leaps. I actually have a recording on leaps, but I'll certainly put that, on the calendar here. I think I just covered weekly options. I covered POW. How do you find when earnings are coming? Is there a website to find out? Great question, Kaz, because we actually are just about to launch our new earnings calendar. And we purposely built this in a way to help you better understand what's currently coming on. And we even give you the liquidity of these rankings. So what we'll do is we'll show you, we'll go out 30 days. So as you can see, there's not a lot coming up, But by by April 14th, that's really when you have the first large cap stock, so J&J, and they're ranked by liquidity. So J&J has a liquidity of 1, JPM has a liquidity of 2, and the liquidity or the big names are always on top. So here on the 14th, I have a lot of regional banks. Bank of America, Goldman, UBS, or United Bancorp on the 15th. And then if you scroll out a little longer here to the 21st, 22nd, 23rd, 24th, we start getting a lot of the technology names: Netflix, eBay, Lockheed Martin, Snapchat, Texas Instruments, Boeing, Facebook, Microsoft, PayPal, Visa, Tesla, Amazon, Intel, Verizon, Google, Apple, Qualcomm. So this is coming out. This is meant to give you a much better understanding as to what's coming out, the liquidity of it, really making it a lot simple for you to do your analysis on earnings. And I am doing a webinar in a couple of weeks on earnings, and I'm going to be launching that tool. So I'm glad I was able to show you guys so what's coming down the pipeline. Thank you so much, Trading. Michael, nice to see your face when you're teaching us. Yeah, we're trying to do more, especially in this time when we're sitting at home all day. We're a little bored too as well. So we're trying to change things up, and I hope that you guys like this. We're trying to almost give you a bit of a CNBC type style of educational event, answering your questions and teaching you the things and showing you how we trade this market. Slides for today's presentation, we'll be sending that out to you. What's the link for the liquidity list is trade.optionsplay.com/liquidity. MP, my first webinar, I'm very impressed. Will there be an app anytime soon? So we're certainly working on that, MP. Thank you so much. I really appreciate it. Will you do one-on-ones for trading? So currently we're not doing one-on-ones, but I am here every single Thursday. I'm able to talk to hundreds of you at the same time, and I enjoy doing this, and I hope you guys find this useful as well. Jake is saying, Jake, your question about space and JPM, I'm happy to look at it, but if you don't mind, send me an email personally at info@optionsplay.com and explain that to me again. I'm happy to look at it, just a little outside of the realm of this cover call webinar. What is the meaning of the down arrow? The down arrow means that Microsoft generated a sell signal. As you can see, this technical indicator here, which is the CCI, was overbought and pulled back below that sell signal. So what we need is a trend that's not bullish, that's either neutral or bearish, and the technical indicator generates a sell signal. That's how we get this red arrow telling you that this is a potentially good time to take a look at a short opportunity. What study have you selected under the stock chart? So you can see it right here. It's a CCI in this particular case. When selling cover calls, I like to sell 1 to 2 weeks out for income and do it over and over again. Absolutely, Wayne. That's a strategy that a lot of people implement. Can you automate strategies with this app? So not automate, but we try to make this process as easy as possible so that you just click on a symbol and you're able to instantly, within a few seconds, know which expiration and strike price you want to sell. Click on the trade button and enter this trade into your brokerage platform. We want to make this where you're not pulling up an option chain and taking a few minutes to get the information, just a few seconds. KC, Jaff, thank you so much. Travis, Lucy, Gilbert, Randall, Surin, Ralph, thank you so much. Tony, in the income settings for cover calls and short puts, how do you choose the time frame? So you choose it based on short, medium, or long term. You select one of these. Will you have any other advanced strategy webinars in the near future? Yeah, so we will be doing credit spreads, debit spreads. We'll be doing some volatility topics coming up. I have a lot of stuff planned for 2020 in terms of more advanced strategies. Even some of the strategies that I don't like to trade that you guys have asked me for, like straddles, strangles, butterflies, condors. We want to introduce some of the volatility indicators for that as well. So yes, we have a lot of stuff coming down the pipeline in 2020. So I hope that you guys will join us for that. How do you sign up for the Tuesday call? It's the same link, so that link will give you both the Tuesday and the Friday sessions. What's your take on Boeing? I think the decline back to 130 is an interesting move. I think that if you're looking to buy the stock, certainly now these levels look somewhat interesting. I would certainly look at sell puts. Look at the discount factor, 7.9% discount by selling put options on Boeing as opposed to buying the stock using a limit order. If you were thinking about buying Boeing, that's the way that I would go. Is the volatility too high for buying LEAP? So LEAP options are trading at a much lower vol. So if those of you that watched me on CNBC last Friday, I showed you that the going out to September, the volatility is half of what the weekly options are trading at. So if you go out to LEAPs, they're still trading at fairly normal volatilities. They are elevated, but they're much more reasonable. Greg is asking, if we do a 3-week short put at 98, for example, what happens when the stock goes to 95, but then goes back to 100 before expiration? Greg, that's a really good question. If the stock moves below your strike price before expiration and then comes back up above expiration, you actually may not get executed. So that is one of the major differences between a limit order and a short put. So great question there, Greg. Michael's saying, for selling a strangle, you would use a preferred short put and credit and cover call strategy with the same expiration, I think. Short strangle would use the same. No, I don't think I would do that. I think for a strangle, I would use probably something like a delta based approach, something like selling a 25 delta call, 25 delta put, unless you have a directional bias. Any thoughts on SPY or Microsoft? I think I covered that. And if you have specific symbols that you want to cover, I think that's better for the Friday morning sessions where we go over ideas and themes and specific strategies. If selling a put to enter VOO, the smartest way to get the lowest entry, what other ways can I reduce my initial entry cost? I don't know of any other ways to reduce your entry cost other than selling cash secured puts and selling cover calls subsequently on it. Tony, I'm in general GE. Do you still feel confident about them? I don't have a lot to comment on GE simply because it's not a stock that I invest in. It's not a stock that a lot of places actually cover on actually. So I actually don't have a lot to offer, unfortunately, on GE at the moment. How do we determine the risk of assignment when selling a put or put spread? So that's what the POW tells you. POW tells you the probability of expiring worthless. So that gives you a sense for what are your chances of being assigned. In this particular case, the inverse of it, right? So about 45% chance of being assigned. If you choose a lower strike price, let's say you choose the, I don't know, the $95 strike price, now you have a 73% chance of expiring worthless, so about a 25% chance of being expired. So that's how you can utilize that tool to help you understand. Wow, a lot of questions here. So thank you so much for all the questions, but unfortunately, I don't have enough time to get to all of them, but I do appreciate all of you taking the time out here this afternoon and joining me, and I hope that you guys find this format useful of the options educations every Thursday. I will try to do the live stream more often. I'm going to have Michael Coe back as well on a much more regular basis so that we can give you a more in-depth version of CNBC, right? CNBC, we literally have many times 30 seconds to a minute to convey an idea, convey a trade to you, and we don't really get a chance to follow up and tell you more about it and give you a chance to ask any questions. So Mike and I have been talking about how we can do a live stream maybe once a week, share with you some of our ideas, some of the themes, because for us to post a single trade on CNBC, we go through 10, 15 different trades that we look through. And some of them are also great trades that we never get to share with you. So we're really looking forward to coming back and giving you guys a forum to show you some of the ideas that we're looking at, provide a more in-depth understanding as to the thesis for the trade, as well as giving you an opportunity to answer those, ask some questions about those trades. So you're not just following us blindly on, what is effectively just 30 seconds or a minute of information. So thank you so much, everyone, for taking the time out here this afternoon. We will send out the recording to you afterwards with the slides, and I will see you guys either tomorrow morning for those of you that are able to join me, or Tuesday morning next week, or next Thursday on the next options education. So with that, thank you so much. I hope everyone stays safe, and I will see you guys tomorrow morning. Have a good evening.